U.S. inflation accelerates in June. Fed's preferred inflation indicator on the rise. Consumer prices on the rise. A closer look at June's inflation data. The Federal Reserve's key measure of inflation has revealed a slight uptick in consumer prices for June, prompting the central bank to keep a vigilant eye on potential inflationary pressures stemming from tariffs. On Thursday, the Commerce Department disclosed that the Personal Consumption Expenditures (PCE) index experienced a monthly increase of 0.3% and a year-over-year rise of 2.6%. Notably, these figures surpassed the expectations set by economists surveyed by LSEG, indicating a notable acceleration from the previous month's increases of just 0.1% and 2.3%. The core PCE, which excludes the often volatile categories of food and energy, it also rose by 0.3% month-over-month in June and 2.8% compared to the same month last year. This annual figure exceeded forecasts, reflecting a rise from 2.7% in the prior month, while the monthly increase was up from May's 0.2%. The Federal Reserve's focus on inflation targets. Federal Reserve officials are particularly attentive to the headline PCE figure as they strive to steer inflation back to their long-term goal of 2%. However, they consider the core data to be a more reliable gauge of inflation trends. In June, the headline PCE climbed from 2.3% to 2.6%, while the core PCE also saw an increase from 2.7% to 2.8%. In a related development, the prices of goods rose by 0.6% in June compared to the previous year. Durable goods saw a 0.9% increase, while non-durable goods experienced a 0.5% rise during the same time frame. Additionally, service prices surged by 3.5% year-over-year in June. Wages and salaries saw a modest increase of 0.1% in June, marking the slowest monthly growth rate since at least November. Meanwhile, the personal savings rate remains stable at 4.5% of disposable personal income. The impact of tariffs on inflation. Both the headline and core PCE inflation rates have risen more rapidly than anticipated on an annual basis. This PCE report from the Commerce Department follows the Federal Reserve's decision to maintain interest rates, as officials remain alert for signs of inflation resurgence linked to tariffs imposed by President Donald Trump. The Federal Reserve has kept its benchmark federal funds rate steady for the fifth consecutive meeting, maintaining a range between 4.25% and 4.5%. Fed Chair Jerome Powell emphasized that policymakers are well positioned to observe the economic effects of tariffs and are prepared to act swiftly if there are indications of a weakening labor market or a significant rise in inflation. Powell remarked, "Higher tariffs have started to more clearly influence the prices of certain goods, but the overall impact on economic activity and inflation is still uncertain." He elaborated that tariffs could either represent a one-time adjustment in price levels or lead to more sustained inflationary pressures. Market reactions and future expectations. Michael Pierce, the deputy chief U.S. economist at Oxford Economics, noted that the latest PCE report indicates a slowing consumer base, with tariffs beginning to exert upward pressure on prices. He stated, "Tariffs are starting to leave their mark on inflation data." While inflation in services remains subdued, aided by a slowdown in housing inflation, core goods prices have surged. The probability of a rate cut, as indicated by the CME FedWatch tool, fell from 46.7% following the Fed's pause to 39% on Thursday, while the chance of maintaining current rates increased from 52.4% to 61% during that same period. What are your thoughts? As we navigate these economic changes, it's essential to consider the implications of rising inflation and the Federal Reserve's strategies. Do you believe the Fed is doing enough to manage inflation? Or do you think more aggressive measures are necessary? Share your thoughts in the comments. U.S. consumer spending heats up, but so does inflation. Hold on to your wallets, folks. because it looks like the economy is walking a tightrope. Consumer spending in the U.S. ticked upwards last month, which is generally good news. But here's the kicker. Inflation also decided to join the party. This creates a complex economic picture that's worth unpacking. According to data released by the Commerce Department, consumer spending rose by 0.3% in June. This follows a flat performance in May, suggesting that Americans are still opening their wallets, which helps keep the economic engine running. Think of it like this. When people buy things, businesses thrive, and that fuels job creation and overall economic growth. But here's where it gets controversial. The same report revealed that inflation also accelerated. The Personal Consumption Expenditures (PCE) price index, which the Federal Reserve uses to gauge inflation and set its target rate, increased by 0.3% in June. This pushed the annual inflation rate up to 2.6%, the highest it's been since February. This means that the prices of goods and services are increasing, effectively making your money buy less. So, what's driving this inflationary trend? One significant factor is the impact of tariffs. These are essentially taxes on imported goods, and they're starting to make their presence felt on store shelves and online. While the initial impact of tariffs is felt by the companies importing the goods, these costs often trickle down the supply chain and, ultimately, are passed on to consumers in the form of higher prices. Gus Faucher, chief economist of the PNC Financial Services Group, noted in an interview with CNN that consumers are largely holding up okay, despite these price increases. He also pointed out that the economy has been slowing down over the past year, with slower job and income growth. This, combined with the added pressure of tariffs, is making consumers a bit more cautious. Economists had anticipated this uptick in the PCE, partly due to rising gas prices, which had been falling for much of the year, and the increased cost of goods due to tariffs. The report confirmed these expectations. Energy prices jumped by 0.9% after a 1% drop the previous month. Prices for goods also rose, with durable goods, like appliances and electronics, seeing a 0.5% increase, and non-durable goods, like food and clothing, up 0.4%. This marks the highest monthly rate since January, when prices spiked after holiday season discounts. And this is the part most people miss. The impact of tariffs is not always immediately obvious. While the price increases might seem small at first, they can add up over time, eating into your purchasing power. As Faucher explained, consumers are likely to notice that their paychecks don't go as far as they used to. Let's talk about the elephant in the room. His administration's use of tariffs on imported goods is a key driver of these price increases. While these tariffs aren't expected to trigger a massive inflationary surge like the one seen in 2022, they will still make things more expensive for consumers. But here's a counterpoint to consider. Some economists argue that tariffs can also protect domestic industries and create jobs. However, the immediate effect is often higher prices for consumers. In the meantime, the stock market seemed relatively unfazed by the latest spending and inflation data. Dow futures were up slightly, as were S&P 500 and NASDAQ 100 futures. What do you think? Are you feeling the pinch of rising prices? Do you believe tariffs are a necessary evil, or are they doing more harm than good? Share your thoughts in the comments below. Let's have a discussion about how these economic shifts are impacting our lives. This story has been updated with additional developments and context. CNN's John Taufigi contributed to this report.